Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Air China Limited annual report. Air China Limited offers a wide range of businesses and services to cater to various needs of its customers. At the core of its operations are air passenger and cargo services, which enable it to transport people and goods across mainland China, Hong Kong, Macau, Taiwan, and internationally. In addition to these primary services, Air China also provides airline-related services such as aircraft engineering and airport ground handling. This includes maintenance, repair, and overhaul of aircraft, as well as provision of cabin and catering services for its passengers. The company's services extend beyond air travel to include import and export trading, human resources management, and financial services. It also offers air ticketing services, making it a one-stop shop for all travel-related needs. Furthermore, Air China provides airport ground handling services, ensuring smooth operations at airports across its network. Air China Limited maintains a market capitalization of $110 billion, broadly in line with the industry peer group. Air China Limited trades at a lower price-to-book ratio of 1.59 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 88% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors that impact an airline's financial performance. Revenue growth is primarily driven by several key areas. Passenger revenue growth has been steady at plus 2.5%, while cargo and mail revenue growth has seen a significant increase of plus 4.3%. Aircraft engineering income has also grown substantially, reaching plus 15.6%. Rental income has experienced the highest growth rate among all categories, with an impressive plus 28.8%. Sales to external customers have also contributed significantly, totaling $161.39 billion. In addition to these figures, other factors such as improved fleet efficiency, stabilized yield quality through capacity and pricing management, enhanced marketing organization capabilities, strengthened product innovation, expanded ancillary revenue streams, increased aircraft utilization, and deepened capacity synergy among Air China family carriers have all played a crucial role in driving revenue growth. Furthermore, the integration of passenger and cargo operations has led to a significant increase in belly-hold operating revenue. On the other hand, revenue decline is primarily attributed to a few key areas. Other operations revenue has seen a decline of minus 16.3%, while revenue from airline-related services and sale of goods have also experienced declines. Air passenger revenue has declined in the Chinese mainland by 2.25%. Additionally, a decrease in passenger yield of RMB 5,829 million has contributed to the overall decline in revenue. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The net cash inflow from operating activities stands at RMB 36,374 million, which is a substantial increase. This positive operating cash flow suggests that the company is efficiently managing its resources and generating sufficient revenue to cover its expenses. As a result, the company's financial health appears to be stable, with a strong capacity to meet its short-term obligations. The company's debt level has undergone some fluctuations over the past period. Initially, there was no significant change in debt levels between $308.2 million and $305.1 million, page 4. However, a closer look at subsequent pages reveals that total interest-bearing debt decreased by 3.25% on page 35. Furthermore, the net cash outflow from financing activities increased by RMB 23,984 million on page 36. In terms of interest expenses, there has been a notable decrease. Total finance costs dropped by RMB 845,234 on page 13, and by RMB 846 million, or 13.22% on page 33. Additionally, the analysis suggests that interest expenses are likely to continue decreasing due to lower total debt levels and currency exchange rate changes, page 35. The company's financial performance varied across different segments and regions. In terms of poor performance, the airline operations stood out as a significant area of concern. The segment incurred substantial losses, amounting to RMB 2,484,013 on one page, and RMB 2,239,127 before taxation on another. On the other hand, the company's other operations segment demonstrated strong performance. This segment recorded a profit of RMB 926,783 on one page, and a profit before taxation of RMB 795,124 on another. These results indicate that the company's non-airline operations were able to generate significant revenue and contribute positively to its overall financial performance. Management has outlined a clear vision for the company's future direction. In its upcoming 5-year plan, the focus will shift towards enhancing quality, improving efficiency, and optimizing structure. This strategic pivot aims to transition the company away from a quantity-driven approach and towards one that prioritizes quality and efficiency. By doing so, management hopes to achieve significant improvements in quality while also driving reasonable growth in production. There are no notable acquisitions or divestitures to report. The company has chosen not to engage in any significant transactions involving the purchase or sale of assets or businesses. This decision reflects a strategic focus on internal growth and development, rather than external expansion through mergers and acquisitions. As a result, the company's portfolio remains unchanged, with no new additions or disposals to announce. The company's financial reports for the years 2024 and 2025 reveal a notable trend. Notably, there are no records of dividend payments made by the company during this period. The absence of dividends payable on page 5 further supports this claim. Furthermore, the company has not engaged in share buybacks, as there is no mention of such activity on pages 15 and 41. That concludes the financial summary for Air China Limited. Feel free to comment below, and I will be happy to answer them when possible.